The items on the site were actually Beanie Babies. Not a fact we widely shared.
eBay was scheduled to launch its public offering in September 1998, at a moment when the world economy was jittery because of that summer's Russian financial crisis. Would anyone want to buy shares in a company derisively referred to as Fleabay? Nobody knew, and the uncertainty was only increased when, on the morning of the offering, the markets opened and eBay wasn't trading at all.
We arrived at the NASDAQ that morning and to see the first trade come across the ticker. And we waited and waited.
But not only did the IPO window open up for eBay, the company sailed right through it with an offering that was a success beyond anyone's expectations.
eBay's stock soared that first day. By the end of it, the company was now valued at more than $2 billion.
The issue was priced at $18 a share, and I think actually went public at $50 a share.
Meanwhile, Wall Street was casting its eyes back at Amazon and liking what it was seeing. Leading the charge was Henry Blodgett, who toward the end of that year declared that despite still posting huge losses, Amazon's shares would double within a year.
I remember sitting on a flight back from Houston to New York with my spreadsheet in the back row and saying, okay, let's run the numbers again. And I came out with a $300 to $500 range and picked the middle one. And I was actually shocked at the reaction.
Blodgett's prediction caused a media sensation, and that sensation sparked a buying frenzy on Wall Street. The result was that Amazon's stock price did indeed double. Not in the course of a year, however, but in the space of just a few short weeks.
That was probably the start of the actual manic bubble.
The fits and starts of the internet bubble were now officially over, and the era of genuine and uncontrolled madness had begun. Suddenly, millions of Americans and investors around the world were stampeding to their brokers, snapping up shares in any company with a .com attached to its name, fueling the wildest speculative frenzy since the tulip mania in Amsterdam in the 17th century.
The Amazon and eBay IPOs made Jeff Bezos and Pierre Omidyar richer than Croesus, on paper at least. But they also had an even larger effect. The IPOs made them famous. As their stories spread, they inspired legions of imitators, business school students from across the country, who suddenly started packing up their cars and heading for Silicon Valley.
When I moved out to San Francisco at the start of 1998, the migration had barely begun. But by the end of that year, after eBay's IPO and the dawning awareness that the gyrations of the world economy weren't going to throttle the boom, a new gold rush was in full effect. You could practically see the hordes of .com prospectors streaming across the Bay Bridge, armed with laptops and half-baked business plans, rather than picks and shovels. And really, who could blame them? Judging by eBay and Amazon, it all seemed so easy. Sure, Bezos and Omidyar were smart and ambitious and monomaniacal, but so were countless MBAs from Harvard and Yale and Wharton. And it seemed as if all the old business strictures had melted into thin air. Experience? Who needed it? Profits? Please. It was a brave new world, a brand new economy, one where gravity and the rules of physics no longer seemed to hold sway.
People in a restaurant, people in a bar were now watching financial news channels on the TV, you know, and looking at how their stocks were doing.
Among all the forces propelling the .com boom, none was more profound than the democratization of the stock market, taking the power away from Wall Street professionals, giving all of us the ability to buy and sell stocks from the comfort of our own homes. To a certain kind of person, this activity became a kind of obsession. They were called day traders, and they started making the stock market look like a low-rent casino.
The day traders were buying stocks in the morning and selling them in the afternoon.
And where did these day trading jokers get the information on which they based their ever-so-shrewd maneuvers? Well, they spent a lot of time absorbing gossip in internet stock chat rooms. But even more important, they spent every waking hour watching CNBC.
It was like a national sport and an obsession in a way. And people who had never dreamed of buying stock before were now just wading right into it.
With the media and the markets now exhibiting an insatiable hunger, for any company associated with e-commerce. It seemed that every software coder in the country was angling to quench that appetite. One such programmer was Philip Kaplan, who would later start a website that chronicled the foibles of the dot-com bubble.
I would go out and do a pitch and literally walk out of the pitch with a $40,000 check, with a $100,000 check. There's just so much money being thrown around this thing. I was like, I can just put up a net and just catch, just a little bit.
The money flowed most freely in Silicon Valley, of course, where a culture of wretched self-promotional excess began to take hold. An online ticketing service based in San Francisco celebrated changing its name with a party for 3,000 people in an airplane hangar.
People were just spending crazy amounts of money. I remember I wrote about a company that spent $10 million on their launch party. They had The Who perform, and they had all these, they raised $12 million and spent $10 million on the party.
Maybe the most lunatic expenditure of all were the TV ad campaigns. During the Super Bowl in 2000, more than a dozen internet startups spent an average of $2.2 million on 30-second spots, blowing $40 million in stockholder cash and not so hard-won venture capital. To many in the high-tech heartland, however, these sums seemed trivial, no big deal, and that created a social system in which some very odd attitudes began to hold sway. Now, Silicon Valley's always been obsessed with money, but this was a whole new thing. I remember one night around that time having dinner with a dot-com CEO and his wife, who patiently explained to me the new class hierarchy at her children's school. If you were worth $50 million or more, you had a lot of friends. If you had $10 million, people would talk to you, but without a lot of enthusiasm. If you had less than $10 million, forget about it. Tom Wolfe famously christened the 1980s the Me Decade. But by 1999, it was clear that the 90s had become the E Decade. Virtually every day, it seemed, at least one new e-commerce venture was brought into the world.
The kids running these new companies were all fervent disciples of the get big fast creed being preached by Amazon and eBay. But when embraced by lesser minds, these theories led to an ungodly amount of sheer stupidity and to a bunch of Me Too knockoff companies with incredibly silly names. There was Pets.com, there was PetSmart, there was Petstopia, there were iPrint and iBeam, iMany, iGo, and iVillage. Then there were the E's, ePrees, eGreetings, eMerge, eFunds, eLoan, eCollege, and of course Epiphany. There was FireDog and FirePond, Razorfish, and Loudeye. Few of these companies had any plausible reason for existing, let alone a basic grasp of strategy or economics. Now you might wonder why the Valley's genius venture capitalists were funding all these derivative, dopey, and entirely hopeless outfits. Were they crazy? Greedy? Well, maybe a little of both. What they were really doing, though, was hedging their bets. They knew full well that most of the e-commerce dot-coms were doomed from birth, but they thought that one in every category might survive or even thrive, and they were willing to risk a couple $1 million so that they wouldn't mess out on the big score.
We're playing, with